Another case study, starting with an IPO. Bullish sentiment is strong following this IPO as demonstrated by the failed double top, transitioning into an ascending triangle that peaked to record highs. It should be noted the ascending triangle breakout was short-lived due in part to the rapid fluctuations in price that often take place during the first year of volatile trading after an IPO. Remember, volatile doesn't just mean bearish price action. It is more accurately referring to rapid changes and wide variations in price. As seen before, such activity on the chart reduces pattern effectiveness, invalidates, or leads to pattern failure. Interestingly, a fairly strict head and shoulders develops, with the 30 to 29 range forming the shoulder level region. That becomes a major range of contention in the future. As JD reaches new highs and reverses back to the IPO range, there is an example of a contrasting formation to the earlier head and shoulders. This formation from April to August has head and shoulders features, in that it is the outline of a gradual transition from consecutively higher downswings to consecutively lower downswings, and has a neckline starting from around 33, extending down to the contentious 30-50 to 29 range. However, the major volatility in early July invalidates the pattern, due to prematurely breaching what would have been the original strict neckline, more precisely closer to 33. It is an excellent case where most of the pattern's features are present to a strict degree, but a short-lived period of volatility reduces the effectiveness and invalidates the criteria. In this case, the neckline becomes too wide, of a range that lowers the precision of the pattern. Here is a case where a triple bottom has a noticeable incline that transitions into an ascending triangle. The upper resistance boundary would have been more difficult to identify, since there was only one clear downswing that incidentally intersects with the old 2280 level. A potential head and shoulders is being delayed despite heavily bearish volume and price action. The 3788 gap up level. The neckline for the potential head and shoulders is also extended down to 3578, where the gap fill begins. Although the uptrend lines are broken, the head and shoulders and subsequent bearish reversals do not progress lower due to the solid support potential of the gap fill. Technically, there was another head and shoulders with the mid-30s gap up range as the neckline. It is a departure from theory because it forms in a neutral to bearish context, rather than the top of an established uptrend. This is a rarer case, but such formations do form from time to time. The similarity to a more common head and shoulders formation in an uptrend is the neckline region that presents key support that produces a strong drop upon breaking. This is due to the transition from bullish to bearish context gradually taking place, from the left shoulder to the right shoulder. Once again, the IPO range provides firm support for a major downtrend. Volatility is high in 2019, but a strict double bottom forms. It has a slight incline, in addition to a stable upward channel upon its more gradual completion, that sees a small downswing onto 2175 before breaking the upper boundary defined by 2280. This strict double bottom is a variation with two minor downswings. However, it is still a highly valid bullish reversal range. A less strict reverse head and shoulders outline could have had an expanded neckline to account for volatile downswings, but that would have drastically lowered the precise criteria of the pattern. Technically, the double bottom to upward channel also produced a compact ascending triangle to continue the uptrend originating from the first upswing in the double bottom. After some prolonged consolidation ranges into the 30s, JD resumes an aggressive incline that begins to slow down on a more shallow trajectory from the lasting influence of previous uptrend lines. August could have finished with an inclined head and shoulders variant containing two pairs of minor downswings, with the lower uptrend line defining the neckline. The bullish surge was more than adequate in avoiding a bullish reversal after failure to definitively close under the potential neckline. Additional volatility and bullish spikes fluctuate price rapidly around the two upper trend lines that become an important guide for support ranges as larger corrections become more plausible. This is due to continued bullish overextension from constant steep inclines.